All right, I'm here. I'm just having problems again. My iPad isn't working. I ordered a new one, but it's not going to be here for 3 to 4 weeks, so that doesn't help you guys much. Yeah, my files aren't opening on the iPad, so I'm going to see if it's just because I don't have enough power. I'm going to try and give it some juice and then try it again. In the meantime, we can just look at the notes in another way. So I wanted to start with, okay, I promised you I'd teach you WAC. So I put a couple of questions on WAC on the test, I think, or one or maybe two. And you could have chosen to do one. Then I put a question. So the questions that probably held you up were the ones with portfolio, deciding on weights, because maybe you never looked at those notes yet, and the WAC stuff, because I never really taught it. I just left it up to you to read through. So I want to pick up from WAC. As far as the test goes, I have to get that to the grader still, because Saturday and Sunday I was in transit. My flight was, well, I was a day late coming, so I'm going to get those to the grader, and she promises to have them back by Saturday so that you can at least study from what, your mistakes. I will be sending you the solutions right away, so you'll have that. So you can hear me, right? So some of you commented it was very hard. Well, I know it seemed hard because you didn't learn that stuff well yet. I'll make compensation the best I can. Maybe, well, we'll talk about it later. Let's see what the grader has to say. And we'll talk about that later. For now, I want to talk about WAC today, and I sent you some notes on options. So we can do options, and then next class we'll focus on filling the gaps and the last chapters that refer to capital structure, choosing optimal debt. Okay, and that'll make sense when we get through it. Okay, so let's see. So this is what, so you may have read through this, or you may not have. So let's do it together. Can you see if I highlight? So we're back to the UAIR case, right? And I want to answer the questions in this second part of the UAIR case and answer them in the lecture notes. The questions are with regard to, and let me just read it. The UAIR, so the Canadian airline UAIR is considering opening a new line to the Bahamas, remember, in the coming year. UAIR's long-term bonds are currently traded with 6.04% annual effective yield to maturity, and the current T-bill rate is 1%. Returns for UAIR stock, the market index, and 90-day T-bill for the past 6 years are as follows. So I've used some data that looks familiar, but I just changed the years to arbitrary, just to let you know I have the past 6 years. So I use -1, -2, and so on. And then I give you information on the dividends, and I ask you to, with the knowledge of the current value of your stock and the corporate tax rate of 40%, can you use the CAPM and the dividend growth model to estimate the required rate of return for your stock? So that's the first question that I tackle in the notes. And so let's look at that now. So I'll get you to the notes. So these are the notes. Let me fit it in a little better. So the notation went from capital R's to little r's. That shouldn't bother you, right? So you should know the CAPM. That's the equation we left off with. The capital asset pricing model really is a line that maps the trade-off between risk and return, so you can use one to estimate the other. All right, initially the focus is on computing the rate of return, required rate of return for a level of risk, but you could do it in the other way around as well. So here I've put the information that's in the handout, okay? And this is supposed to be for Canada, so I'm using numbers that you may have seen in the notes before, but just assume it's for Canada. And I calculate. Okay, so you had problems with the test, lots of statistics, right? Lots of calculations. If you had more chance to practice, it would be much more easy. But as it is, yeah, it takes some time when you're still working through it. But the most important thing is that you understand, and that it's just tedious calculation that you have to do. If you use Excel, if you set up Excel for yourself, that'll make it easier for the final exam. I'm just charging my iPad on the side. Okay, so what we have here is a calculation of the expected return, right? And the expected return for the stock and for the market index. Okay, so I'm calculating them as averages with the assumption that they come from a symmetric, it's symmetric data, right? That's what my assumption should be. I have enough observations in there. I have some high ones, I have some low ones, and they balance out. So I figure I'm going to use the arithmetic average, and I use the same thing for the market. And then I calculate the standard deviation and the correlation coefficient. All right, now these could be done because it's historical data. You write it like that, but you could just put it in your calculator. Remember how we learned to enter this as X and Y into our calculator, where the market index would be X, that's always on the X-axis, and the asset is always on the Y-axis. So this would be X, and this would be Y in your calculator. So you can confirm all those numbers on the next page yourselves with your calculator. Okay, so I'll just leave that for you to double check if you haven't already. And also, you should be able to get the beta. Why don't we just do that? Let's just take a moment if you haven't done it. Let's put that all into your calculator and get all these numbers for me quickly. You should be able to do it quickly. Let me give you a few minutes. Yeah, you can, I've had some concerns mailed to me about the final exam, about the lockdown browser, and some students are really concerned it's going to stress them out and ruin the exam. So I'm opting to do a meeting with Zoom, and your video has to be on so I can record the entire exam. So you'll have to have your video on, so you still need a webcam, but we won't use the lockdown browser. But yeah, you shouldn't be cheating at any rate. It's going to be too fast. The exam's going to be too quick for you to spend time cheating. So you're going to have the video on you, and I will videotape you together in the meeting room. Okay? You have to set it up so I can see you. So Senna asked, anyway, you guys should be entering this into your calculator. Senna asked me about how to do this in Excel. I don't have time really to show that, but I think I have a file I can send you. I have a file that's all set up. I'll send it to you. I'm going to make a note. It's an Excel file, and you can just change the numbers and see the formulas already written. I prepare all the formulas. Yeah, I'll share that with the class if you want to try that. No, Kamalpreet, you cannot go back and forth, just forward. So I'm going to send you an Excel worksheet with those formulas. I don't know if you guys can hear the noise in the background. Is they're my 2 air conditioners that are going. It's very hot here. Well, very humid, so we have air conditioner on in the one main room. So I hope that's not distracting. Spencer's asking for a practice exam. I do not have time to set up a practice exam, but basically they're going to be like your questions in the MyLab Finance, right? You're going to have questions. Some are going to be, I said about, between 30 and 35 questions, and some will be multiple choice, and some will be fill in the blank, and a couple of written questions. You have to express yourself. And it should be doable in 3 hours, and it should be passable. Those are my conditions for the exam. I have a sample that I'm supposed to work with. There's anyway, supposed to modify it for you, and I'm going to be doing that on the weekend, preparing it. So I don't really have the exam yet. Well, I have it, but I have to edit it. Okay, so are you guys doing this? Did you get these numbers? Anyone? Alan's asking, you can see the assignments in MyLab Finance by selecting results. You can select, that's what the representative told me. By selecting the results tab, you can see all the questions. So that's why I felt like I should leave all the questions available to you. So even though you didn't answer all the questions, you can study all the questions. Yeah, you hit the results tab and you should see the practice questions. I'll send a note about that too. Okay, Andre, you got it? Got the numbers nice and easy? Very good. I'm just writing down. I'm going to write you guys a note. Anybody else? Because I need to move on. So you put these numbers in your calculator and you got these results, right? You even got the slope. So this one will not be in your calculator, correct? But how can you get it? Who knows how to get this number from your calculator? You guys are not answering me. Okay, you cannot get it directly on the calculator, but if you take, to get the covariance, you take the R times SY, I just wrote it in the chat. To get this, you would have to do, it's R times SX times SY. So all those numbers in your calculator, you have. Okay? Right? Because what is covariance? Covariance is the standardized correlation. So you have correlation, all you have to do is divide, well, you have the correlation, all you have to do is multiply it by the standard deviations. So you should be able to get it. Very good, Nicole. Good job. All right. So that's not so bad, right? So we're going to simplify this by using our calculators. And I'll send you that file of Excel. Well, it shouldn't be 0, so you're going to have to check that. Muskan. Alright, so you guys work on that. I need to move on. So just make a note to yourself to double check that and let me know if you have trouble. To communicate with me, email me. If you really want to text me and you don't mind international charges. Did I already tell you this? No, maybe I didn't. So this is my number. You can text me. And I have an iPhone, so you can message me. And yeah, my Winnipeg phone doesn't work down here, so that would be my number. Okay. Okay, so this is what we got. We got 1.55, so it's more sensitive than market returns, right? It's sensitive to market returns, this stock for UAIR. So using that information, we need to calculate, we need to get the market risk premium, right? Now we could do that if you solve for the T-bill rate, the average T-bill rate, what would you get using this data here? Okay, so if you use this data here, the average T-bill rate would be 2.365. That would be the arithmetic average. Where the average market return was 5.11 that we computed here, right? So we have, we could calculate the historical market risk premium using this information the average. So I'm not using the current T-bill rate. I'm using the average. If I use the average, I would get 2 points. So notice what we're doing, right? Usually I just give you RF, but now I'm using the average as though there was no variation. I mean, as though there is variation. And I get 2.75333 repeating. So if I use this as the average market risk premium over this period and put it together with the T-bill rate of 1%, because that's currently what's available, the CAPM that I would get, the CAPM would look like this. So the 1% plus the beta that we computed plus the historical market risk premium. So the new thing is this thing, using the average and the average historical market risk premium. If I do that, I get the expected return for UAIR's stock as 5.273277. So that would be a more robust, because I'm using, history, not just, I'm using the historical returns on the market with historical T-bill rate. That should be more stable than if I just use the current one. Robust, I don't know if that's a better word for it. Okay, more reliable. And I could even go as far as using the last 82 years of information. Let's say I use the last 82 years of information and it turned out that the T-bill rate was 3.7% on average, and common stock return was 11.3% on average. Then your historical, now look, it's going to be, the historical market risk premium would be 7.6%. What did we get? 2.7. So if we use that number, we get as high as 12. So what I'm showing you is what you use, your assumptions, and what you decide to use for these numbers, for these variables, impacts your results, okay? So I just use these numbers, even though these are the American numbers, I just put them here because I didn't have quick access. Well, the truth is, I don't want to change all my numbers in my notes. So just pretend that those are historical for Canada, okay? And I just wanted to avoid making mistakes in the notes by changing one thing. All right, so just notice the point of this exercise is to realize the sensitivity given your assumptions. So what I conclude is it's very different if you use the last 6 years than if you use historical, like all the history, the last 80 years. So notice that the higher the required rate of return for an investment project, the less likely it will be that projects will be accepted, right? So the convention is right here. The convention is to use the more current data for a robust or reliable estimate of the cost of equity. So my point there, again, is you could make different assumptions and get different results, but we'll use the more current data as for a reliable estimate. So the more current with the last 6 years. And so we're going to stick with our number for now of the 1 minute. Yeah, the 5.27 figure, okay? So we're going to work with this one for now. 5.27, 3277%. So that is the required rate of return using the CAPM for UAIR, given the other assumptions that the beta of stock was 1.55, that's the best one to use. So we just use the last 6 years of data. Any questions? Muskan is asking for 1.55. That's your slope, Muskan. That was your slope in your calculator, okay? So in your calculator, back to this first page, second page, you can get this out of your calculator as the square Sx squared. That's what this would be. Let's put that down. So this would be Sx squared on your calculator. Can you see what I'm doing? Okay, so that would be Sx. Oh, sorry. So you would have to take Sx from your calculator and square it to get that number. All right, so that would be Sx squared. This one, as I explained, you could get by taking R, Sx, Sy. And this is just a slope, 1.55, 2038. Muskan, I cannot help you right now because I'm going to do the class, so we can look at that. Let's look at that during the break, okay? I will do that during the break. All right, so where were we? So then, continuing with the problem. So I use the CAPM, and I settled on this as my required rate of return for the CAPM. And now, sorry, I'm flicking through these slides. So now we're going to do the same. Well, we're going to do this differently. We're going to use the the dividend growth model. Remember the dividend growth model? Using this information, I want to use this form I want to use the formula for perpetuity that we use to value stock as the present value of future cash flows, where the cash flows are a set dividend, C1 forever, C1, and then a constant growth forever. So that's my assumption. If I use the dividend growth model, my assumption is constant growth, and that I know C1. Okay, so if you have to be given different information now in using the perpetuity. Instead of solving for the price or the value of stock, you're going to be solving for the return, or the I, right? The interest, the implicit return to stock. So you need the first cash flow, the first dividend, you need the price, and you need the growth rate. So what all that we're missing, we're told that the next dividend, we're not told anything about the next dividend. We're given this information here about dividends. So you need to figure out from that information the growth rate, and you have to figure out the next dividend using the growth rate. Nicole, what is your B? 1.55? That is supposed to be B. That's what it is. It's a slope. V is the slope. V is the slope of the best fit line. So it should be that number. I'm going back to the first page again. I'm sorry for people. Yes, you should be able to do most of these calculations in your calculator. That's why I made you buy it. Okay, so the slope, as crazy as all these numbers look on this page, you can get these numbers very directly out of your calculator if you know how. Okay, so this is just the slope. This is just B in your calculator. Now you know. All right. Okay, back to what I was saying. I'm sorry, I keep on. Okay, I'm going to avoid, write your questions and I'll address the questions during a pause because it's getting choppy. All right, so what we're going to do is we're going to assume there's a constant growth rate. Assume there's a constant growth rate, even though it doesn't look like a constant growth rate, right? Because we have two 24s and then two 25s, and so, but we're going to assume one, and that's why I write it like this: 1 plus g to the power of 6, as though growth was constant. 1 plus g times 1 plus g times 1 plus g 6 times. After, using the first dividend up until 0. So then notice 6 plus minus 6. So like 6 plus minus 6 takes me to 0. So that's the subscripts are helping me know that I did enough growth, right? So there's 6 periods of growth from the first cash flow at -6 times -6, and that gives me the dividend at time 0. So then I plug in the initial dividend, the 20 cents, and then the last dividend, 25 cents, and I solve for G. So you do this calculation to solve for G. So this is how you would determine a constant growth rate. It's a, as though it's a geometric average. Okay, so then you use it to get the next one, and that's how you know the next one is 25 cents, almost 26 cents. But you don't round, because I don't want you to round intermediate calculations. You keep it on your calculator. Store it if you must, and then plug it in here. So using the formula, I've written it with the notation of the dividend, so C1 or D1. The first dividend coming next period over the price. I have the wrong price in there. How did I do this? But I think if you put the right one in, it'll be fine. This happened. I never fixed this last time. So this should be 10.25. I hope it doesn't change the number. Oh my goodness. So let's see which one it should be. So tell me what the price should be to get this answer, because I don't want to change it. You see, this is what happens when I change my notes. Let's see which one it is. You guys tell me. Okay, I'm going to start at the top so I have the decimals right. Okay. I have to check what I wrote in the Sorry, I'm here. I'm just checking my numbers. Okay, so it has to be 10.25, right? I'm just going to check that what did I make the price on the handout? Oh my goodness. 10.25. Okay, so 10.25 it is. So correct that in your notes. And everything's fine. Okay, so what are we doing? We are using the dividend that's coming in the formula here over the price, current price, or actually, yeah, current P0 is now, and then adding the growth rate we computed up here, and we get this. So if we use a dividend growth model, it's similar to using the CAPM. The result is similar. Yeah, it's just similar. This should be fine. It's the same number. Sena. Okay, I just had the wrong number in there because I had changed it at some point to do another exercise or make it more realistic or whatever I did. So there, that's the right number. Okay, so this 6.320523 is similar to the 5% that we got for CAPM. So what should we conclude? How should we work with this? So now notice, remember these results, right? These were the cash flows that we computed for your case. We assume that UAir is an all-equity firm, so they only issue stock. They finance with stock. And we also assume that the Bahamas project beta is the same as UAir beta. So those are our major assumptions for this problem. And we also use the recent history of returns to compute the historical market risk premium. Okay, so Sena's asking, when do I do which one? I will instruct you which one to use, okay? Or I'll ask you to compare them and which one would give you, be more likely to accept the project. If it's an investment project, your required rate has to be exceeded by the project, right? So the required rate should be lower. But I'll usually tell you. I think I always ask you directly which one I want you to use. So here it's very similar, and when you actually calculate the IRR of the project, you see that the internal rate of return is 10%. So in either case, if you use the CAPM or if you use the dividend growth model, you will accept the project, right? Because it's 10.26%. Get it? Notice if we had used the long history, all of the data of 82 years to calculate the market risk premium, we would not have. So you see it's going to be sensitive and you have to make your decisions outright. Maybe calculate them all and then pick one and then state why you would pick one over the other. In this case, we prefer to use the more recent past because we think that's more reflective of what's coming. All right? And these numbers, you just assume this data I gave you were for, they're not set in years, they're just fictional years, okay? Okay, so how does this look? Okay, let's see. Any questions? Any questions about that? No? Okay, let's go on. So what does this look like? Here we have the SML. Remember, we plot the beta as the measure of risk and the expected return to the asset as a measure of return. And because the beta was 1.55, we estimate that what happened here? Right. We with the CAPM we estimated here on this, you guys can see what I'm doing here. So here is the expected return for UAir using the CAPM, and it's on the line, right? If you trace through the line using CAPM, you will end up on the line. The internal rate of return for the project indicates that the return on the project is 10.26%. That's way off the line, right? This is undervalued, and so you should pursue or attain this asset, attain this project, right? You will buy and hold it. In this case, when it's not an asset, it's a project, so we should pursue this project. Okay. And okay, so then what if we consider we have to make this more realistic? UAir is not a completely equity finance firm. Let's say UAir has debt. So how do we deal with this? Let's first look at the question and how I phrased it. Let's first look at the question in the exercise. The question states, so we just did this. We did these two problems. We said use the CAPM and the dividend growth model to estimate the required rate of return for UAir stock. In other words, the cost of equity capital. Then we assume that UAir is an all-equity firm. We continue to assume that it has no debt on its balance sheet. Calculate the NPV of the proposed Bahamas line with the CAPM cost of equity capital calculated in 1. What assumptions do you have to make with respect to the project's risk and capital structure for this NPV to be relevant? And I mentioned them in the notes, okay? All right, so now here we are. Now assume that UAir is a levered firm. That is, it has debt on its balance sheet. Given that 53% of its assets in market value is financed with equity and 47% with debt, estimate the WACC for UAir. Okay, so we got to put this together. We have 53% of its assets in market value is financed with equity and 47% with debt. So it has part shareholder and part creditors, debt holders. Some investors could be both, right? But I'm going to speak about them. I'm going to speak about them as separate. Well, you'll see what I mean when I get to it. We'll speak about how we treat either group of investor. So So here we have the balance sheet, and we understand that assets should equal equity and debt. We're going to use the symbol S for equity and the symbol B for debt. And the firm's assets are financed by both. So the value of the firm should equal, in a balance sheet, should equal outstanding value of stock and the outstanding value of debt, the market value. It's got to be very clear. It has to be the market value of the assets, not the book value. Okay, so the notation I'm going to introduce, so S is the market value of outstanding stock, which is also called equity. RS is the return on equity, the cost of equity. That's like the required rate of return for stockholders. And it's also the return for dollar invested that the firm would have to pay to stockholders. Okay? The beta S is the systemic risk of equity. So that's just the portion of risk attributed to stock. Everybody okay with that? B is the symbol we'll use for the market value of outstanding debt. RB is the return to bonds. So that's going to be the yield on debt. Okay, the yield to maturity. And the beta will be the systematic risk of debt. So that's the beta for the bonds. Firm's assets are financed by both of them. So we say V is, right, like I said on the first page, the market value of assets. And we see, just like the partitions, the parts of equity and debt have their own risk-return trade-off, so too does the firm's value. The market value of the firm has its risk-return trade-off. Okay, so there's a return to assets of the firm, and I'll refer to this as the return to the average investor in the levered firm. So if there's an investor who's invested in the same proportion that the firm has part debt and equity, so if it's, in our example, was 57 and 43, so the average investor would be someone who's invested the same way as the firm is levered. So leverage is the word for a firm that issues debt, a levered firm. This word here. Okay. And the beta of assets is a measure of the systematic risk of a levered firm. So that's, again, the risk associated with being invested partially in debt, partially in equity, in the same proportion as the firm has debt and equity. Okay, so what am I talking about? So these are the proportions I'm talking about. Okay, so if it's an all equity firm, then S plus B is the same as S, right? So B is 0 here. So it's 100% equity. That would be the fraction of equity would be 100%, and the fraction of debt would be 0%. If the firm was all debt, then the bondholders, then they would only have bondholders, and the ratio of debt debt to value. So like on the denominator here, it's just V, right? So you could also see this written as, this could also be written as B over V, but I don't do that. I don't know. I just never like to write it like that. But you'll also see this. This is the same thing, right? And same thing here. You guys okay with this? But the average investor would have part invested in debt and part invested in stock, and the average investor would be invested in the same ratio that the firm is financed. So these ratios apply to the firm just like they do to the average investor. Okay. Okay, so S is a measure of the market value of outstanding stock, where R is the return to shareholders. I've already said this, right? So B is the market value of outstanding debt, and RB is the return to bondholders. And V is the market value of the firm's assets, which is just S plus B. And the return to assets is a return to the average investor in the firm. And the person's an average, it's considered average because it's investing in the same proportion that the firm is financed. Those ratios of B over V and S over V are the same for the average investor as they are for the firm. Okay, and just to make a point, if the firm is just an all equity firm, then the return on assets is the same as RS. If the firm is all debt finance, the return to assets, so the return to the average investor in the firm would be the same as the return to debt holders because it's only bond holders. But if there's a levered firm, so it's a firm with equity and debt financing, then the return to assets is the same as our WACC. So I have to teach you how to compute the WACC if you didn't learn it already. WACC, and I mentioned this to you before, we call WACC the cost of capital of the levered firm. So this term, cost of capital, if it's just an equity firm, it's called cost of equity. If it's just a debt firm, a debt finance firm, it's cost of debt. But if you put it together, we call it the required rate of return of the average investor in a levered firm. We call it the WACC, or the cost of capital of the levered firm. So all these terms mean the same thing for WACC. How do we calculate the WACC? So this is what I want you to look at right here. What is going on here? How can you say what this is in a few words? And the words are already on the slide. Nobody? I want you to say weighted average. It's just a weighted average. It's a weighted average. It's a weighted average. But it's like, good job. You guys are trying. Okay, so in a few words, this is the weighted average. It's the weighted average cost of capital. It's the title, the WACC. It's the weighted average of the return, the required rate of return for stockholders and the required rate of return for bondholders. However, there's a catch here. And what is this? So when I write the WACC is the weighted average cost of capital. So this is what is being paid out. So this is like the financing cost for the firm. So this is why the firm would have to require this rate of return, because they actually have to pay back, or they have to pay for financing their projects, their operations. All right, so what you have here is you have the portion, the weight, right, with the return to shareholders, and then you have the weight with the return to bondholders, but there's this extra term. Why is that extra term there? Can somebody tell me? Even though it's on the slide, can you say it in your own words? Or anyway, even if you say it in the slide words, what is happening there? Why does that extra term exist? So everything makes sense, right? It's a weighted average, debt and equity. The only thing that I want you to explain is what is 1 minus TC doing there? What is 1 minus TC doing there? But tax what? Why is that there? Okay, Al. So tax savings for what reason? It's on the slide, but so the point is, this term is here because the fact is that for every dollar, that's what this represents. This is every dollar, right? Whenever I show you returns or interest rates or rates, this is for every dollar invested by the average investor in the firm. They want to get the return for their portion of risk from equity, or their return from equity and their return from debt. But the fact is, from the firm's perspective, the firm doesn't have to pay RB for every dollar invested or every dollar borrowed. Okay? They actually can expense, they can claim, reduce their taxable income by the debt payment. So they pay out less than RB. This is a number less than RB. It's RB times 1 minus TC. It's a fraction of RB. That's why. Okay, so the firm pays bondholders interest payments for RB for every dollar invested. However, the firm also incurs tax savings, TC times RB, for every dollar invested. Therefore, the cash outflow of the firm to its bondholders and the cash inflow to bondholders of the firm for each dollar invested will be RB1 minus TC. So this reflects the effect of tax savings. Got it? Okay, you guys are doing a good job with that. So that's WACC. Now remember, the CAPM maps return to risk through that line, the security market line. We'll have to take account of the fact that we're going to be dealing with the after-tax cost of debt. And that's what this RB1 minus TC stands for, after-tax cost of debt. I'm going to put a note about that. All right? Because that's how I'm going to refer to it. Okay. So with the question that I gave you for UR, let's calculate the WACC. So I'm going to use the return on equity that we computed, the 0.05273, and I gave you the fraction that was equity finance, 53%. And here is the cost of debt and after tax. So this is the yield to maturity after tax, and then this is the ratio of debt financing. And so why don't you guys try to punch that in and make sure you can get the answer, all right? Confirm you get the answer for me. So this would be the adjusted required rate of return. This would be more accurate if in fact this was the debt to equity. These are the new ratios because it was a levered firm. Levered or levered debt finance firm. You guys hear my keyboard clicking? I'm just responding to Senna. So we're going to do some exercises before I continue on to options. So make sure you can punch that in. You understand what you're doing. Are you guys punching that in just fine? Okay, got it? Very good. Okay, good. All right, so what did we get now? So we have now a new CAPM. Sorry, what am I saying? We have a new required rate of return, where we use CAPM to get the return to equity, right? So I still call it the required rate of return CAPM, but it is it's this part, the equity part was from CAPM, and then I used the WACC to get the whole thing. And now what do? What did we get? We got a smaller number. So this is going to happen because the return on debt is usually smaller, right, than the return to equity. The required rate of return for debt is lower because creditors have a promise. They have a promise or commitment through their certificate, their bond that they purchased. It promises to pay them a certain amount on a certain day, etc. So there's less risk associated with that, and so too there's a lower required rate of return. So that will overall lower from 5%, it's down to 4.5%. I kept all the decimal places there for good habit, but you just follow directions on giving me the final answer. So there I have 6 decimal places on my percentage. All right, so we know that we're still going to invest because we just made the required rate of return smaller, and it's the internal rate of return, remember, was 10%, so that we're still going to accept this project. Didn't change our findings. So I'm going to answer the last couple of questions. What if, so I'm going to change something else here. We assumed that the beta for UAIR was the same as the beta for this project to the Bahamas. Now, maybe that's not the best assumption. In fact, when looking at this and looking at the industry betas, are looking at historically the industry betas for these kinds of trips, let's say we found out that, or I should call them these flights, right, for this destination of Bahamas, the beta is much higher. It's much higher. It's much more sensitive to market returns. Okay, people are not. It's implying that, when the market does well, the Bahamas line or flights to the Bahamas do very well, 5 times better. But when the markets do poorly, the flights don't. The destination is not as popular, and it's not as popular. It's dramatically. It's going to be, the reverse. So it's very sensitive, highly sensitive with a beta of 5. So how's that going to change things? So we have to go back. We have to recompute the CAPM for the Bahamas project, and I've used the name Bahamas to distinguish it from UAIR. I'm going to continue to use the historical market risk premium of the 2.7% we got for the last 6 years. And now I have an expected return of 16% just for the return to stock. So this is the expected return to stock using the CAPM and the new beta. So this beta here. Recalculating now the WACC, because I have to fix that, it's going to be higher. When you punch it all in, you get 10.33%. Now what are you going to do? Remember that for the internal rate of return, now you can appreciate, why we get the internal rate of return, because we can always just compare to the internal rate of return and see in this case that the NPV is going to be a negative. We shouldn't invest. The internal rate of return already tells us that. The return on the project is 10.26%, and our required rate using this new beta for the equity is 10.33%. So we should not invest in the firm. Got it? So notice the assumptions and recalculating changes the required rate of return. So if you think about it, in the last several years and more recently, T-bill rates have gotten increasingly low, even negative, some of them. How is that going to affect investment decisions? What does that do? Well, how did the T-bill rate figure into our calculation here? So it would just make the required rate, the cost of equity, it's already 1, so it's not going to dramatically change much if it goes down. But it could, if going negative, it could even make it lower. The expected rate of return, the cost of equity at least, will be lower, and that could lower your required rate of return in your WACC, okay? So that's how you see the incentive, lowering the T-bill rate is an incentive for investment or pursuing projects, because it will lower your required rate of return for investment projects in the firm. Okay, so the question now you guys are asking me about the bonds. Okay, so let's do some exercises because I didn't play too much with the bond rate. Let's do a couple and you'll see. Let me see what the last slide has to say. Okay. Just to mention, there could be other assets, right? The firm could have other classes of investors. What if also the firm issued preferred stock? You would include it also as a cost. So that would just come as another fraction where I'll just put P as a preferred stock, and you would have to get the valuation of stock outstanding, and then you could calculate the V, which would be the denominator, and the return to preferred stock. So I have some examples like that as well. All right, so you just keep on adding in those portions of cost that would go to the firm for every dollar invested. Okay, so let's see, exercises that I gave you. Yeah, let's just do review. Called it review 4. So we have review 4 and review 5. So that's all I gave you. That's enough, right? Anybody go through them? I think they're enough. So let's see. Let's go for review 4. You can see that? So this is review 4. I'm going to look at the solutions with you. My iPad still isn't working. I don't know what I'm going to do. Okay, so open up review 4, solutions. Okay, so now let's try this together because you guys need to be able to do this. Okay, so here's the information. So Diversification Incorporated has the following capital structure. It's $25 a share. There's 12 million shares outstanding. Debentures are, well, this are the bonds, right? So it's 1,100 per bond, and there's 300,000 outstanding. So you can figure out from here, S. So I'm going to ask you find S and find P. Not P, B. So find S and B. So you can do that. The market value, no, I'm not going to do it there. Let's put another column. So S is equal to, and B is equal to, how much? You guys tell me. Al's got it, right? 300 million and 330 million. So this is just going to be the 25 times 12 million. All right, so that's 300 million. And B is going to be 1,100 times 300,000. Can I say 0.3 million? Okay. So you got that, so we got those. So then, what we want to figure out is, assume diversification stock has a beta of 1.6. Diversification's bonds have a stated coupon of 12. Coupons are paid semi-annually, and the bonds mature in 12 years. Calculate the expected returns for diversification securities and the WACC. So look what I have to do here. First, I use the CAPM. Is that okay with everybody? I won't write it. That's a CAPM with the, I guess you can't see when I do that. The CAPM is computed with the risk-free rate. Where did I get the risk-free rate from? At the top, you see? Risk-free rate, 6%. And the expected return on the market portfolio is 14%, so it's 8% market risk premium. And that gives you 18.8 return on equity. Everybody's fine with that? That's using CAPM. Now for the debt, first we set up the problem to find the yield to maturity. Remembering it's 12% coupons paid semi-annual, so that's $60 every 6 months. Don't forget this last term, and don't forget how to enter this into your calculator. So could I ask you all to try that? So we haven't done bonds for a few weeks maybe, so now you have to remember that. The one advantage of doing this course in 5 weeks is that I can refer to something that was just a few weeks ago and it should be rather fresh. So it's different when you teach the course and go slower, and then I'm talking about months ago. So okay, so tell me if you can get that, you remember how to enter that into your calculator to get that amount. And we're not done yet, but See if you can get R equals 5.25 from your calculator. I'll wait for 5 of you to get it. Andre got it? Anybody else? Okay, right. So you guys are kind of forgetting. So you have to make, okay, from left to right. N is 12 times 2, right? 24. So 24 goes into N. And then interest is what we want to find, so don't put that. And then PV is the price, right? So we have the price. And we have to enter it as a, well, it depends. We just have to make it consistent. So let's say we were the bond holder. So we paid negative 1100 goes into PV. And then the payments are 60. And that goes into payment. And then FV is the 1,000 that you're going to get, because you're going to get a payment, so that'll be positive. And then 1,000 is going to be the face value. That's how we refer to FV for bonds. And so the only thing is that you have to have a negative for the PV for the price. The other ones are positive. Okay, so you guys got it. All right, now, are we done? Nope. We have to convert that to the annual effective rate. Okay, I want you to get the annual effective rate. How do you get the annual effective rate? You have to convert it to the annual effective. So get the EAR for debt. And then after tax. So you could put it in as, so I have the numbers here. You could put the 1079 with the 1.4 together before, or just in the formula, that would be fine. So you need to create these ratios. These ratios, you should store those. You should store those in your calculator. So you can store that in 1, and you can store that one in 2. So this is where it's going to be really handy to be good with the storage keys. Questions? I keep repositioning my document. Any questions about that? So try and, use the storage keys for these amounts, or it can get really messy. Let me see if we can do another one. I'll pull up the question paper. So how did I get this? This is S over V. So this is S divided by V. And this one is B over V. Yeah, where V is S plus B. Okay, I'm going to ask you to try the second one without looking at the answers. See if I can open. Okay, the second one, you have to get a lot of betas. a lot of good questions on here, guys. Okay, let's just do number 2, because they're very similar. So for question 2, I've done the calculations for you. Let me open the question. No, actually, I'll just push down the answer. Okay, using the information I'm giving you, and I gave you here the total value, and I even gave you the ratio, okay? I made it super easy for you. So it's a weighted, it's like a portfolio, right? This is the portfolio weight. And, but this is actually representing the proportion of assets financed by stock, and this is the proportion financed by debt. So assume that RF is 4% and the expected return on the market portfolio is 15%. CanWest's equity has a beta of 1.2. Its bonds have a stated annual coupon rate of 13%. Coupons are paid semi-annually and the bonds mature in 6 years. CanWest pays 45% corporate tax rate. Each bond has a face value of 1,000. So how do you get CanWest equity? The expected return on CanWest equity. In other words, the cost of equity. What would you use here? You have all this information. You can probably use CAPM, right? So that's what I use. Here's the CAPM. And $17.2%. But this is similar to the other problem. Also now calculate the cost of debt. Similar computation. Why don't you try this one? Punch in this information. Now I want to deal with the betas. Okay, so solve these two, and then we'll go on to the betas together. We already have the beta of stock. It's 1.2. Okay. So you should be able to get this easily with negative 975 as the present value. The payment is 65. The face value is 1,000. And the N is 24. It's the same numbers, similar numbers anyway. And you get this expected return. Then you have to convert it to the effective annual rate. So the RB is going to be the EAR, the effective annual rate, the yield to maturity. That's what I need for my WACC. And then I multiply it by after tax, 65, so it's 55%, or 1 minus 0.45. So this is my cost of debt. The cost of equity is higher, cost of debt is lower, and I don't ask you for the WACC right away. Then I ask you to get the debt, the beta of debt after tax. Why do I do that? Well, I want to use this one. After tax. So I can use it in the CAPM to find the beta of debt. So the beta of debt after tax can be calculated as 0.340723. Does everybody get that? So I'm tracing then, I'm going from risk to return, return to risk. I could go both ways. So I take the return. This is the return to debt holder as well as the cost of debt from the firm perspective, and I can calculate the beta on debt. And then, so I can, rather than using the capital asset pricing model, rather than using the WACC formula of the expected return, what am I saying? Rather than using WACC as the weighted average cost of capital to calculate WACC, I could do it this way. Let me see what my screen, what have I done with my screen? Here. That better? All right, so are you guys caught up? What we've done so far is computed. I computed first the return on equity, then return on debt after tax, then the beta of debt after tax, and I already have the beta of equity. If I put them together, I can get the beta of assets. So this is the weighted beta. And with that, I can use the CAPM to get the WACC. So I just don't have a whiteboard right now to show you this. I don't know what has happened to my iPad. I have to find another way to demonstrate this to you. Let me see if I can use another software. But basically, they're all on the capital asset, the security market line. I'm going to try and open another whiteboard. Okay, maybe this will work. Okay. Let's see what happens. Um, Sorry, I went small. Whenever I zoom out, it shrinks the screen. I shouldn't zoom out. Can you see that? I can't see that. Do that again. iPad. That didn't work. All right, there we go. I got a new screen. So what we're doing is we have beta here, and we have expected return to assets here, right? And we have the SML here with RF, capital or lowercase. And wait, I gotta fit the screen, don't I? Let's fit it. All right, so if we get the beta of debt after tax, and we get the expected return to debt. So I have all these different notations. I hope you're comfortable with them. I have to make this bigger. Okay, that's expected return to debt. So those map through the SML. And then let's say I put equity on. Now equity is going to be higher up, right? So this would be the beta of equity. I'm going to just make a note that this is after tax by saying after. I don't know if you can see that. I'm just going to make a note over here. After tax. Okay. So we put equity here. And then this would be the return on equity. And where would WACC be? Anybody know? Where would WACC be? It's a weighted average. So as a weighted average, it's a linear combination. It's going to lie on the line in between, exactly, center between these two. So WACC would be, depending on how much you have of either of them, it would be, it would be here if you had more debt financing than equity, and it would be closer to equity if you had more equity financing than debt. So so it should be in between. So you should visualize that, and you should check your numbers also. If you don't draw this, at least make sure that if you did everything correctly, it should be between. So WACC should be, I'll put it in green here. So this would be the beta of assets. And then this is going to be what we call WACC. In the middle. Okay? So visualize that when you make these calculations. I hope you can see that is the SML. Let's take a 5-minute break. I'm going to ask Muskan to let's work on that. What's wrong with your calculator? What's going on with the calculator? And I'll give everybody else 5 minutes. Sena's asking if you should draw it. You don't have to draw it, but if you want, you can draw it. It might help when you have a lot of numbers. It's nice to plot them out to see that it all makes sense. It's all consistent, right? So if you made a mistake, you would catch it. But pretty much the WACC should be between the two returns, and the beta of assets should be between the two betas. Okay, so you guys take 5 minutes. I'm going to see what Muskan is doing, or whoever wants to do that exercise with that we began with. So I'm going to write 5-minute break. Okay, so let's see. Let me put up that exercise calculation. So it would be this one. And it was all right, so let's enter these values. So what you're going to do to enter these values is you hit second function, data, and you have to start by clearing the whole thing out, right? You need to clear what you have in memory. Okay, so clear. So second function, actually, why don't I show you the calculator, right? Let me see. I'll show you the calculator. No, that's what I want to do. Okay. So let's go to the calculator. See that? So I'm in the calculator. Second, data. I'm in the calculator and I need to clean it up. Clear work. And then I enter each of these values in turn. So I enter 4.91, enter down, and then Y would be 10, enter down. And then 15.79, enter down, and Y would be 30, enter down. And then 5.49, let me know if I make a mistake, and then 10, enter down. And then the next one is 37 negative, enter down, and 55 negative, enter down. 26.46, enter down, and 40, enter down. 15.06, enter down, and 30, enter down. Now, I ask for a second stat, and I go through the linear results. So there's 6 observations, and that's the mean. That's the standard deviation for the market. If I square that, is that going to give me the result? I think I have to enter these as decimals to get, otherwise if I square that, it's going to screw things up, isn't it? So I got to enter these as decimals. But anyway, let's just see the rest of it. So that's the standard deviation of X, that's the standard deviation, oh, that's the variance, so I don't use that number. That's Y bar, standard deviation of Y, which is U air. And that's A, I don't need that. And here's my B. You see, I still get the right slope. And then my R is 99, like almost perfect positive. Okay? Yes, Kyla, theory type questions. Not, well, like the ones I've been giving you. Like the ones in the MyLab Finance. Work on those problems, remember. It's going to look more like that. But the things I've given you are supposed to help you conceptualize and understand things better. Okay, let's see, what did I do to get standard deviation? So it's going to turn out with the right numbers. So I would say enter these as decimals if you want to play around with the results. But still, the beta will be the same. So if I enter 0.0491, enter down, and then 0.1 down, 0.1 enter down, 0.37 negative enter down, and 0.55 negative enter down, 0.2646 enter down, oops, what did I just do? Enter down, and then 0.4 enter down, and 0.1506 enter down, and 0.3 enter down. And now second stat and the linear results, same thing, right? So these are percentages now, and that's that. And then I still get a B of 1.55, okay, whether I put decimals or percentages. The point is, though, that I need to use decimals to be able to make a variance out of these values, or to manipulate them. So if I square that, I get the variance that you see on this page here. Okay? For slide 3, what is the y value? Not sure what you mean. There is no y. You just calculate. In that case, you just leave it. You skip it. You have to clear second clear work, and then just enter second data. Wait, second data, then second clear work, and then as you enter, you just don't put anything in the y. You put 0.031, enter down, and you don't put anything for the y. You skip it. You keep going down. 0.0468, enter down, and then down. So you skip it. Okay? Because it's two variable statistics, to get one, you just have to override the second variable. Okay, Muskan? So work on that. I'm going to get back to the notes. All right, so what can I say? I don't have a functional iPad. I'm going to let me just finish with the problem we're doing. Okay, so for the problem that we are doing, we've got the beta of debt and the WACC. By using the asset beta in the CAPM, I can get the WACC, or I can use the formula for WACC as the weighted average cost of capital. Both of them should give me the same answer, either method. All right, so then there's just several exercises like this one. And what you can do, oh, I did do a nice graph here in the solutions, didn't I? See, I did a nice graph. That's the graph that I just did in colors. It should always be like this in general. And where the WACC falls will depend on what proportion you have. If you have more equity, greater proportion of equity, then it'll be closer to beta S and RS. If it has more debt, it'll be closer to the beta after tax and the after tax cost of debt. So what we do with this number, now this should be the required rate of return for the firm. So you can value projects using the WACC now. So you should just practice all of these. I mean, they're all virtually the same. So tomorrow you can have the TA, you can ask the TA questions about it. See here, I calculate the NPV using the WACC. And then some theoretical questions that are not that hard. What would happen if you did such and such to affect the WACC? What would that mean about investing? And so I'm just scrolling through here. They're all similar questions. Remember, we also call WACC the hurdle rate. the rate you have to, you know, exceed, in other words, to actually pursue the project. And I have some other type of questions here for you guys to contemplate. All right, so that's that review. And then there's another review using preferred stock. So I'm going to ask the TA to go over review 5 with you tomorrow. And any questions you have on review 4. And then otherwise, I'm going to be giving you, I'm going to send you something on options, but right now I want to get into options. I want to get into options. I have to figure out how I'm going to do that without without my iPad. Let's see, I'm going to show the notes up here. I'm assuming you have no questions. So you're going to work on that, okay? It's just a matter of practice with those notes. So it wasn't that hard, was it? It wasn't that hard after all. So what I want to do is open the file I just sent you. I really wanted to start off with the overview, but that's not going to work. You can see my options notes. So this is 6.2, because 6.1 was meant to be like an overview, but it's not gonna be as neat and tidy now. Well, anyway, let's see. Okay, so let's talk about options. Well, Muskan, SY will be 0 because there's no Y, okay? There is no Y. In fact, it entered Y always as 1, so standard deviation would be 0. That makes sense. Okay. Okay, we're going to talk about options. So, options in the last 30 years are derivatives. Let's talk about derivatives. Derivatives are securities that are traded And they're called derivatives because they derive their value from an underlying asset. Okay, options are a type of derivative. The idea about options, the notion is, can an investor reduce their downside risk by holding options? Well, what are options? Let's start there, and then we'll talk about pricing options, okay? So we're going to stick to talking about non-dividend paying stock because that makes it more complicated, and this is just an intro course. So I have to define my terms, and I'm going to give you some review exercises. We're going to get through them today, and I'm going to give you another review that you'll work on with the TA tomorrow. And then on Thursday, we're going to focus on, like I mentioned, on capital structure, optimal debt. And it'll make sense when we're done. Okay, so options. There are European options and there are American options that we're going to learn about. And there are call options and put options. We've talked about, this is going to sound familiar. You guys can tell me how, but let me introduce the concept. So a European call option, it gives the holder of the option, so someone who buys it, the right to buy the underlying asset for a predetermined or prescribed price, which is called the exercise price. They can buy that asset at a set price on a set date. That date is called the expiry date. So there's lots of terminology there for you, but I'm just going to repeat the terminology so you'll get used to it. Okay, so a call option gives a holder the right. On the other side of this trade is the person who wrote the option or sold the option. That person has the obligation to honor the option contract. So you can see these as contracts. Okay, so in this case, the person has the right, the holder of the option has the right to buy the underlying asset, and the writer of the option, the person who made the deal, is obliged to sell that underlying stock. Okay? Then there is the put option. The put option gives the holder the right to sell the underlying asset for the strike price, I'll use the terminology, on the expiry date. So the person who holds the put option can sell the asset. On the other side of the contract, the writer of the put option must honor the contract and must purchase that asset. All right? So why would you, let's say, take advantage of a put option? In what situation, what scenario would you take advantage of a put option being available? So what you're going to do if you were looking at buying a put option is you would have to pay a price, and options are sold in lots, so you'd have to buy not just one, but you'd buy 100, and we'll use that as our running assumption. So 100 options, for 100 underlying shares. So when would someone want to buy a put option? when would they want the right to sell the underlying asset? The price is going, they're going to want to buy it only when what? They will want to purchase the underlying asset when what? So these are the things you have to think about. They want to sell in what situation? So Spencer says when they expect the price to go up. Well, so this is it. So when an investor has anticipation different from the writer of the option, there might be an opportunity for profit, okay? They'd buy a put option when they believe that a stock price is falling. They would purchase a call option when they believe that a stock price will rise in the future. Okay, so let me illustrate this. I'm going to try, if you guys can open up the file that I called 6.1. I really want to use 6.1. And let's see, I can show it here. So I'm going to instruct you on how to fill this chart in. I find it makes more sense if we look at the big picture. So beginning here in this first graphic, what I've done is I've plotted on the horizontal axis the stock price, and on the vertical axis the payoff at time t. What I want you to do in that first graph, I want you to plot for me the what it would look like. What would the stock price, how would I plot the stock price on this on these axes? So if you were to purchase the stock, what would be the market value of the stock? Okay, so what this is a snapshot, okay? This visual, this graphic is a snapshot at time t. T stands for the expiry date. So let me write down some notation for you. Okay, I'm going to write down some notation at the top. So E is going to stand for the exercise price. You see that? And ST is the stock price at time t. This should be lowercase. Lower. Don't know how to make it lower. So it should be ST like over here in the chart. And T is the exercise date. So the exercise price is the same as the strike price. Okay, so that's the terminology that you need. So if the stock price was So the stock price was here, what would be your payoff? So if you purchase stock, so in this quadrant or this graph, I think I can do this all in PDF. See how this goes. If the strike price was, let me turn that off. Sorry. So if the strike price was, can you see my cursor? No, you cannot see my cursor. Let's do it like this. So if the stock price was this, then the payoff would be the market value of the stock. If the stock price at time t was this, then the payoff would be this. Okay, that's how this graphic works. That's why it's a straight line. Depending on what the stock price is, that will determine I'm here, I'm just learning my new tool. That will determine the payoff. Got it? So if you own stock, that's what your payoff is going to look at like at time t. So this is for what we call a stockholder or a person who's long in the position. Long, right? We talked about long, buying and holding. So I can write long. If you're in the short position, what will the graphic look like? I'm going to put it here, and it should give it away. What should the graphic look like if you're in the short position? What is the short position? That's where you've borrowed stock through your broker, and then you have to return it at time t, let's say. Okay, that's what we're going to do here. So what would that graphic look like? Nobody? So if you were to it would be the opposite. That's right. It would be just the opposite because you have to return it for that amount. So it would be like a negative. So 0 is, oh, this is, I'm losing my, oh dear. I don't know that this is the best way, but I'm getting straight lines. All right, so it'll look like that. And these would be negatives because 0 is right here. It's negative because if you short the asset, you have to spend money to return it at time t. Okay, so you should be drawing this. You should print this out. Or I could just take a blank sheet of paper and start drawing with me. It's going to be 3 columns. And what was I going to do? I was going to put 0 here. This would be much neater than if I drew this. Okay, and then what we'll say is the payoff at time t for long would be st, correct? I can't make a subscript, that's the only thing. Making them both smaller. This is terrible. I'm so sorry. Let's see. There we go. So that's what it should look like. Okay, so that's ST. If you short the asset, then it would be negative ST. Are you guys dying watching me do this? And that would have a negative in front. I can't do this. Okay, so I'm going to go to my tablet just to give you an idea. That's what it's supposed to look like. Okay, so what I'm going to do is I want you to think about, this is for stock, long and short. I want you in the two below, I want you to do this, a drawing for a call option and then a put option. And then here, I want you to do it for a T-bill. So this is going to be for call. This one's going to be for put. And this one's going to be for T-bill. And these are very small, so I have to make it bigger, which I can't. So that's what I want you to do. So what I want you to just set that up on your page, and then I'm going to go onto my tablet whiteboard and do this, and you can copy it onto your pages. Unfortunately my iPad is not working. So that's call, put, and T-bill. All right, so write that on your page, and then I'm gonna go to the I'm going to go to my whiteboard. Okay, it wants to go this way. So in the upper left, no, I'm not going to be able to use this application. This is no good. I'm really at a loss here. What happened to my software? Okay, I'm gonna continue with the Acrobat. At least I get straight lines. Okay, so what would a call option look like? So holding a call option, I'm going to mark now the exercise price. The exercise price would be here. So let me mark that. Okay, so that would be the strike price or the exercise price right here. And if you were to long a call, so you actually hold the call option, you have the right to buy stock at the price E. What would be your payoff? So if the stock price was 0, at time t, and you had to pay E for it, you're holding the option. Would you, so we say, would you exercise the option if the price was 0? You would have to pay E and it's worth 0. Would you exercise the option? Yes or no? No, right? It doesn't. It's worth 0. Why would you pay E to have an option worth nothing? So in fact, we say that option would be out of the money. It wouldn't be exercised, and rather only values beyond E would put the option in the money. Okay, so all we would have are valuations after E. Okay? On the other side of that contract is the individual who sold the option, the call option. Likewise, that person would be, that person, the writer, would have the obligation to do what the holder wants to do. So only after this point, if the price, so don't think of this as a duration axis. This is just a snapshot, and I'm just showing you the alternate, the possible prices for the stock. So the person holding the call option has the right to buy stock at a set price, and it's an obligation for the writer to sell it to him. I can't get my lines going. Oh my goodness. Ah. So I'm going to make it over here and move it. Alright, so it would be the mere payouts, because this money has to be spent at this point in time by the writer of the option. Okay, so these would be up here. These would be positive payouts of what amount? What would be the payoff to the person holding the option? I'm going to try and make sure you understand this graphic, or it's going to be a waste of time. For the person holding the option, it would be the maximum of 0, and ST minus E. That would be the value here. I'm using a little t because it should be a subscript. I can't make it go down. Okay, because the payoff will be the individual would have to purchase the stock for E, and then because the market value is ST, provided ST is higher than E, the market value of the stock, it's like the payoff of this transaction would be ST minus E. So Kyle is asking, where does ST come from? So the idea of ST is just, it's what is. Okay, so I'm going to give you exercises where I'm going to give it to you. I'm going to say this is the stock price at a certain, at the expiry. It'll be given. So I'm just showing you the possibilities. It could be any of these along this horizontal. So depending on what it is, that would be the payout. So on the other side, the person who's short in the position, the writer of the option would be at time t, they would get the negative of this amount. So their payoff would be negative. The point is the maximum the most you can lose at time t as a holder is 0. I'm going to put it in there. That's a negative for the writer. Okay, so you see both sides of the transaction at time t. Now, what happens at time 0? At time 0, there was a transaction where the person who purchased the option paid the writer a fee. Right? Something for the option. Not the full price of stock, of course, but some price. Nominal price, small. So that's a call option. What would a put option look like? Try and do the drawing for the put option. So if you are so Kyle's asking, well, you don't really want to lose, right? Well, the thing is, the person on the other end of the transaction is thinking differently, right? They're thinking that they made money at time 0 and they're going to pay out 0, like the option will not be in the money. So if you look at the net from what is time 0 to time t, maybe they'll make a profit. That's what they're thinking, because they got paid the transaction cost for the option, and then they don't even have to, they're not obliged to do anything because the option is out of the money. So over here we say option is in the money, and on this side it's out of the money. And the option is not exercised. Okay, so I want you to draw it for puts. Try the put here. I'm just trying to say, okay, so what would the put look like? Think about it. So the put option gives the holder the right to sell the underlying asset at a set price. When would that be in the money? And what would that look like? So they're going to be able to sell, holding this option at time t, they'll be able to sell for E. When is it worth selling for E? And it might be the case that the person who holds the option doesn't necessarily have, oh sorry, I'm saying this backwards. So the person who's selling the option, they want to sell it for a price at the time, might not necessarily have the stock when they initially buy the option. Okay, I haven't specified anything at time t. What would it be worth to sell stock that they don't currently have? That's how you have to think about this. Well, so what we're thinking is these are the different prices. If the price was 0, let's start at 0 again, right? So if the price is 0, the market value of the underlying stock is 0, but the writer of the option, who will say is short in the position, the writer of the option has to buy it from you at the exercise price E. So you're going to exercise the option, right? You're going to exercise the option in all these cases here. And you're going to get, what's your payout going to be? So this is going to be the opposite. This is going to be here. It will be, I gotta turn that off. Here it will be out of the money. And here it will be in the money. Up until E. So what will the payoff be? The payoff will be, depending on the stock price, so we're eliminating downside risk. You can never get lower than 0 as an option holder at time t. You're going to lose something if it's out of the money because you lost the transaction cost of buying it, right? But it's not huge. It's not like the value of stock. So the price up here would be the maximum of 0 and E minus ST. Because E will always exceed ST in the money for the put. And this will be the mirror. So the idea is, remember, if you hold the option, the put option, you don't necessarily own the stock, but you'll have to go buy it so you can sell it, right? So you're going to buy it for 0, let's say if the price was 0, and then sell it at E, and you make E. If the price is higher, you have to go buy it for whatever that ST price is, but you get E when you sell it to the writer of the option. All right. And the payoffs for the person in the short position, they're forced to buy the stock. So again, it's a mirror. And I'm going to plot also, this is E, and this is minus E. And the payoff to the person in the short position would be the negative of the payout to the payoff for the holder of the option. All right, are you guys okay with these drawings so far? Now I'm going to create, on the last drawing is a T-bill with face value, I have to add this in, with face value E. What would that look like in this plane? At time T. So no matter what the stock price, there's no correlation, right? It's going to be simply if you long the T-bill, it's just a long line, straight line. That's right. If you short it, then at time T, you would have to pay it back, so it would be a negative. It would be in the negative quadrant. One straight line. That's supposed to be straight. Okay, so these are the payoff diagrams for these securities, for these positions. Got it? Is that all right? Okay. So keep those in mind, and let's go through the notes now. So that's like an overview. I'm going to put more on this drawing in a bit, but let's get to the notes. Any questions about the drawing so far? Okay, let's get back to the notes. What is it, Harper? Okay, let's look at the notes and then let's see if you have questions, okay? All right, so as I said, so these are European options, that's what I've described. Gives the holder the right to buy the underlying asset for a prescribed price on a prescribed date. A put option gives the holder the right to sell the underlying asset for a prescribed price on a prescribed date. And then American options, they have an exercise price, but the difference is the exercise or predetermined price and a predetermined expiry date. However, they can be exercised at any point in time during the life of the option. Okay? That's the difference. So the notation I've used is S for the underlying asset. It's the specific asset on which the option contract is based. So that actually could be for other kinds of assets. I'm just going to focus on stock and non-dividend paying stock. But it also could be, you could have an option on bonds, you could have an option on real estate. If you've ever purchased, you know about real estate, you know about options. For traded stock options, one call or put option contract represents the right to buy or sell 100 shares of the underlying stock. Okay, so it's not just one share, you'd have to multiply by 100. Did my screen freeze? How did that happen? Okay. Not sure why it's... Okay, it moved. Okay. So I said, yes, one call or put option contract represents the right to buy or sell 100 shares of the underlying stock. The exercise price, E, is the specific asset price at which the asset can be bought or sold by the holder of a call or a put if it's exercised. And T is the expiry date. Okay, so you guys got the idea. So we call a writer the seller of the option who takes the short position in the option, and the holder the buyer of the option that takes the long position in the option. So we talk about the elements of the option contract, if it's a put or a call, the style, is it American or European, what kind of asset is underlying, stock, bond, for example, the unit of trade, so it's usually 100, and the exercise price and the expiration date. People are asking me questions. Yes, Al, has to be the same stock. Harbor is asking, what does it mean with E on the long axis? Let me just clarify. So all it says is no matter what the stock price, if you hold the T-bill, you get the payout of E, the face value at time T. That's all. That's all. It's just there. You'll see how I use it. Okay, but basically, no matter what the stock price, you always get E. If you hold it, no matter what the stock price, if you shorted it, you get minus E. Your payoff is minus E because you have to go buy the T-bill and return it to whoever you borrowed it from. Okay, Harper? Okay, so let's look at some of the elements here. So holding a European call option contract for an example. European style IBM Corporation, September 100 call. Entitles the buyer or the holder to purchase 100 shares of IBM common stock at $100 per share at the option's expiry date. So there's greater detail than the drawings I gave you. I was giving you just like the theoretical understanding. But here are some numbers. You actually have numbers now. Some people like the numbers. So for the call option holder, remember, as long as the stock price exceeds the exercise price, the holder should buy the option. Buy the stock. Okay, so exercise. So if the market value is 105, for example, so I'm just showing you that it's higher than the 100, they should pay $100 to get it from the writer, and they realize a payout because they could turn around and sell it on the market for $105. That's the idea. Okay, the market value is 105. Whether they do it or not is irrelevant. The value of this of exercising the option would be $5, which is positive payoff at time t. If the stock price is less than E, the holder will not choose to exercise the option. Okay, because if they really wanted the stock, they'd go buy it for $90 themselves, for instance, something less than 100. Why would they exercise the option and pay 100? Okay, so there's no payoff from having the option. The option is worthless at time t, and the payoff is 0. Okay, so I haven't put the 2 time periods together. I'm just talking about time t right now. What happens at time t? So in this drawing, in this slide, we can translate, this was just one example, but you see it fits our graph, right? That the payoff should only happen for a call option as long as the stock price exceeds the exercise price. For our example, it had to be 110 or more than 100 for the holder to exercise. There's my drawing. Got it? Now, what about the writer? Let's look at the other side. Now, the writer is obliged to carry out the wishes of the holder, the one in the long position. So if the stock price exceeds the exercise price of 100, the holder will exercise, and the writer will have to deliver the stock with a market value of 105 to the holder, and only in return for $100 to the holder. So they're out of money, right? They lose. There's a loss of negative $5. If the holder does not exercise, then there's no negative payoff for the writer at time t. Again, I'm just looking at time t. So the conclusion is a call option writer will never gain at time t, since his payoff is never positive. And you can fill this drawing in. And I've put the formula here, right? the call option value of time t would be E minus ST. No, Kyla. It's that the writer just has to do whatever the holder wants. He's obliged. The writer is obliged. Okay, they don't have a choice in the matter. So, hey, if this is the first time you've seen this, you just be patient because it'll all sink in when I'm done, or hopefully before. My computer. Oh my goodness, I have to turn this off every time. I need to practice with this. Okay? So I'm just repeating, but with numbers, what I did before. Let's look at the put. So it's really important. I mean, there's a few details, but once you get them, you'll see it's very repetitive. So what about the European style IBM Corporation September 100 put? So that's how it would be listed. It entitles the buyer to sell, who's also the holder, to sell 100 shares. I prefer to use the word holder because there's a lot of buying going on, because you have the buyer who buys this option and then the one who has to buy. So the holder has the right to sell 100 shares of IBM Core common stock at $100 per share. And the results I'm giving is per share, right? Even though it's 100, like this is per share. So you got to multiply these payoffs by 100. I'm just making these payoff diagrams per share. So what happens now? So put option holder is anticipating that the stock price will fall, but they've obliged the writer to buy stock from them. So what they're going to do is take advantage of, well, if it happens, they're going to take advantage of a stock price fall, you see? So if the stock price falls below E, the predetermined or preset expiry, or stock, what they call the strike price, then the option is in the money and exercised. The put option holder receives $100 for IBM stock with a market value of 90. So if the put option holder didn't have the underlying stock, they could go buy it for $90 and sell it for $100 and see a payoff of $10 a share. However, if it didn't happen that the stock price fell, in fact, if it rose above the strike price of 100, the option would be out of the money and the payoff would be 0 at time t. So let's draw that. So we draw that again. The payoffs, depending on what happens with the stock price, like that. So this is for, so put option, just think that it's for low stock price. Okay. And as I said, it's in the money when the stock price is low, out of the money otherwise. On the other side, you have the writer who have to buy the option, have to buy the stock from the put option holder. Since the stock price falls, if the stock price falls, the holder will exercise the option and the writer will have to pay E dollars for a stock that's only worth $90. So if the writer bought it for 100 and then decided to turn around and sell it, even if they don't sell it, if they just hold on to it, at time t, the value would be -10. The payoff at t is -10. If the stock price instead rose, the option would not be exercised, so nothing would happen and the payoff would be 0. So the writer at time t can either get a negative or 0 payoff. So we finish this drawing. This one will look like. Like that. And notice E, the exercise price, is here on the payoff axis. Alright, so you got those drawings. Now what we're going to think about is combining positions. What do you get if you hold these positions? You purchase stock. What would be the payoff at time t? You short sell a call. What would be the payoff at time t? And then combining them, what would be your payoff? So you're buying stock and you're short selling a call. So in other words, you're writing a call option. So this is where you're in the position that, for being a writer of a call option, you have you're selling the right to buy. So you're going to hold the stock and sell it, turn around and sell it to them. What would be the combination of that? So this is a covered call. You actually have, as a short seller, you actually have the stock. So combining this is a matter of combining the drawings. So I'm going to go back to the other drawing and show you that. So in the second column, let's put those positions. So the first one is to hold stock, right? So you will, can I copy this? Let's see. Oh my goodness. No. So there's longing stock. And then I'm going to short sell a call. So it's going to be a you're going to write a call option, right? So you're in the short position. So what you have to perceive here, I'm going to put here the E here and E here, and you line these up. And what would the combination create in theory? If I was to combine these, what would the combined positions look like? So we're going to put the 85. Well, they put 85, but it's doesn't really matter. What is happening? Okay, so the E would be 85. So what's going to happen is you should think this is 0 plus 0, so that would be 0 down here. And then here, can you see my cursor? Can you see this cursor? I don't know if you can see the cursor. So we're going to go, imagine if you're at 0 on this one and you're going to add it to 0 here, that's going to put 0 down below in the combination. If you're at E, you're going to add E. So if the stock price is E, then the payoff is going to be E if you own the stock, right? But down here in the second drawing at E, the put will be worth 0. So what you're going to get in the combination is E. So you're just adding off the payoffs from the top and the bottom one, and you'll see that it's going to look like this till E, and then a straight line. after E. Okay, so what does that say? If you hold them in combination, you're going to get a payoff a positive payout even if you're the writer. Okay, so as a writer, as long as you own the underlying stock and you write the call, it'll be a positive payout. Now, the interesting thing is that this is the same as another combination. What other combination would give you, what other two positions combined would give you the same combo? If you guys are good with the spatial recognition or patterns, this is good. If you're not, this gets frustrating. You want to just use the numbers. I'll give you examples with numbers that you can practice this. But okay, spatial recognition or pattern recognition. What would give you the equivalent payoff? What combination? Can't see it? So you could get the same with a T-bill and a short put position, right? So this is the same. It turns out that that's the same. So holding a T-bill and being in the short put position. So it turns out that if we go back to the notes, sorry, I gotta turn off the lines. So you can draw it here as well. Buying stock, short selling a call, and the combination is the same as short selling a put and buying a T-bill. So it turns out that there is what's called a put-call parity relationships, that these positions can be created from the three others. So let's see. Should I draw this in here again? So draw that in for slide 12. Now on slide 13, you purchase the Bell Canada Enterprise stock, the July $85 put option, and short sell the July $85 call option. Both options are European. Your payoff at expiration is in July is what? So what I want you to do for next class is read through these. I'm going to send you, because class is over, I'm going to send you the rest of the notes. Not notes, I'm going to send you the some exercises I promised. You're going to work with the TA. And you're going to work through this. I've presented you the positions. You're going to work with this relationship. The fact that you can create positions from the other three positions. And because of that being equivalent, that equivalency at time t, it is the case that the present value should also be equivalent. The present value of these positions. Okay? So that gives us the put-call parity relationship at time 0. This helps us to value options. I want you to read through this, and the TA will work with you on this. So I'll spend a little time on this the next class, and then mainly I'm going to talk about American call, because all I taught you was the European. So you're going to work on this, study with the TA tomorrow, and then when we come on Thursday, hopefully it's just going to be a review and I can explain American call options better to you. All right? So this is it. I guess that's the class for now. I'll review these last few slides. I'll have him focus on the slides till page 18. Okay? So other than that, if you have any questions, let me know. And oh yes, the answers to test 3 as well, send those. So I have a lot to do tonight. And I am 1 hour ahead of you, but that's fine. I will be sitting here. I'll be awake. I'll wait for you to ask me questions. I'll wait another 2 minutes if you have questions. Otherwise, I'll let the rest of you go. I apologize for the iPad not working, but I think the lines were nicer on these notes than I could have drawn on my iPad. So that wasn't so bad. Okay, so say goodbye. I'll say goodbye to most of you. Anybody who has questions, you can ask me now. No, the final's going to have American, Michael. I'm just saying that I will review the American as well next class. I'm going to let the TA do it with you tomorrow, but I will, I'll review it. I'll review it tomorrow as well. Thursday as well. Okay? Okay, good night. Good night, Harper. Good night, Tony. Spencer. Good night. Good night.